Chapter 14, we deal with the finance markets on a big scale. Chapter 13 is financing on a single scale, right? It's looking at a loan, what is a loan, how to calculate interest on a loan, how to calculate discount points on a loan, what is principal, what is interest. It's all those things. We're only talking about how many loans at a time in Chapter 13? One. Talking about a singular loan. Chapter 14 does not care about a singular loan in most cases. Chapter 14 cares about the mortgage market. Bunches of loans. Lots of loans. Somebody tell me the difference between the primary mortgage market and the secondary mortgage market. What's happening in the primary mortgage market? So we're making loans, right? Isaiah said directly from the bank to consumer. That's exactly right. We're making loans. Well, the secondary mortgage market must be making loans too, right? No. What are we doing in the secondary mortgage market? We're selling loans. We're buying and selling loans. We're not making loans anymore. We're buying and selling them. And usually, we're not selling them one at a time. Usually, we're putting them in big buckets and selling them in big batches. Okay?
How do you buy that? Like, the investor just comes and says, I have $500,000. I want to buy it.
They could. They could. Somebody answer this question. Traditionally, what's the most common way these loans get bought?
Fannie Mae Freddie.
Fannie, not banks. Banks are the ones selling them. Banks don't want them.
Right.
Banks want to make loans.
Charge service fee.
They want to charge discount points. They want to charge origination fees. They want to make a loan, sell a loan, get out of a loan. That's what banks do now. So, this secondary mortgage market is designed to take money and get it in the hands of the people doing the lending. Who are the people doing the lending? What do we just say happens in the primary mortgage market?
Buying and selling?
No. Banks making loans. So, the secondary mortgage market, its purpose is to put the money in the hands of the people making the loans. Who's making the loans? The banks. So we're putting money into the bank's hands. That's the purpose of the secondary mortgage market. Otherwise, folks, the bank would have, how many of y'all, I know you don't remember, you probably see it on television somewhere if you've driven through some town that's run down, and Wilson has still got it. Hotels or motels on the side of the road used to have signs that said vacancy with the word no in front of it, and they would the light would either be on or off. It's sort of like the hot donuts now are light at Krispy Kreme, right? They had vacancy, they had no vacancy. Well, folks, if we didn't have the secondary mortgage market, that's exactly how the lending market would be. There'd be a light in front of Bank of America, and instead of vacancy, it would say money, no money. Money, no money. Because if we didn't have the ability to sell these loans to somebody to get more money in the door, the bank would do what? They'd run out of money. They only have so much money to lend, right? And if you don't have any more money to lend, can you make any more loans? No. You'd have to sit there and wait and collect the interest and make until you got enough money in interest to make another one more loan. So you turn the light back on. We have money today. Oh, there's one more person. We're out of money. How crazy, in a bad way, would our economy be if that was the way home lending worked? It'd be insanity, right? Would that negatively affect property values? Absolutely. That right there is the cause of the Great Depression. You can spend weeks, months, years researching the Great Depression, but right there, the bank's inability to lend money caused the Great Depression. It didn't cause the initial collapse. You can have a market collapse without having a depression. We had a market collapse in 2008. Thankfully, we never made it to the point of depression. Recession, but not depression. But the biggest problem we had recovering from the depression, and this is not an exam, but you need to know this because you need to understand how we got to the system we had. The biggest problem we had coming out of the Great Depression and how to recover was how do you make banks lend money when they don't have any money? The answer is you can't do that. So the only way you can fix it is to give them what? Money to lend. That's the only way you can unlock the credit market. And if they don't have money to lend, who's buying? Nobody. And if nobody's buying, who's selling? Nobody. And if nobody's selling, who's depositing money in the banks to make more loans? Nobody. You see how ugly that picture and that circle becomes pretty quickly? Does that make sense? When there's no money moving, everything grinds to a halt. And that's why it took a decade to even see any hope of pulling out of that. So one of the major changes out of the Great Depression was the secondary mortgage market. And the federal government stepped in and said, you know, there ought to be some way that investors could buy these loans. Investors who don't care anything about making loans. Is it possible I have $1 million in the bank that could be loaned out for mortgages, but I have no interest in sitting down and meeting with Carlos about his mortgage? Absolutely. So, is it also possible then that I'd be willing to pay somebody else to do that service for me? That's what investors do, folks. They're paying the banks to perform that service for them. When you buy a mortgage, that's what you're doing. You're paying the bank because the bank's done the work of finding the borrower, qualifying the borrower, and getting the loan made. Does that make sense? And all the investor has to do is come in and say, here's my money.
And collect interest.
And now I get to collect the interest. Because all I wanted was this slow, long-term investment to make money, because this is my retirement, right? Does that make sense to you?
Yeah.
So that's what's happening in the secondary mortgage market. Investors are coming in and they're paying the banks for this service of making the loan. Well, that's all well and good, but when the market collapses, do the investors have money to continue to buy the loans? No. That's where Fannie Mae came from. Fannie Mae came from that problem. It came from that issue where people sat there and they said, how do we fix this inherent problem of we need people to invest money that they don't have? Who always has money? Because they print it right down the damn street. The federal government always has money. Now, you can get into a whole discussion about the value of that money, but they always have it, right? And they always have the ability to tap it, even when nobody else does. Does that make sense? So, a company was created. Now, companies have stockholders, right? Companies have owners. Companies make money for investors. Fannie Mae is all of those things. But Fannie Mae was special because Fannie Mae had the ability to borrow money from the federal government interest-free. It doesn't borrow it all the time. No. Is it borrowing it right now? No. Matter of fact, it's making money for the federal government right now. The key here is it has the ability to when the crap hits the fan. Does that make sense? Did the crap hit the fan in 2008 in the residential mortgage market? Did Fannie Mae have to borrow money from the federal government? Yeah, about $4 trillion worth. It's a lot of money, right?
Just print it out.
They did. But you know what? It all got paid back. Every penny of it. Isn't that amazing? You don't hear that story very often, all right? It all got paid back. Everything Fannie borrowed, it got paid back, plus interest. The federal government made money on that deal. Which is Fannie working at its best. Now, I'm not saying it's perfect. Far from it. But here's the thing. You can still go out and buy a house in 2009. Even with the market collapsing and values falling by 30, 40, 50% in some places, you can still walk into a bank and get a loan. Because you know what kind of loan you could get? An FHA loan, which was backed by the federal government, which is going to be bought by who? Fannie Mae. So if the lender, i.e. the bank, knew that they could sell it, were they willing to loan the money to you? Absolutely. That's the purpose of that system, folks. That's why it exists. So in times when the private sector stops functioning, the government can step in and help. Does that make sense? You get that as a basic understanding. Because I find if you have that basic understanding of what Fannie Mae is, then memorizing what the hell it does becomes a lot easier. Is everybody, are we all right on that? Okay? So, let's talk about Fannie Mae and Freddie Mac real quickly. Fannie Mae was primarily designed, originally, out of the Great Depression, to buy very solid mortgages. People who had very good credit, people who were putting a lot of money down. Would you say that the risk of default on those mortgages is pretty low? Somebody who has really good credit history and is putting a lot of money down, i.e. their own skin in the game. Yeah, we have a name for those. We call them conventional mortgages. If you don't have that in your notes, put it in your notes. Conventional mortgages. A conventional mortgage is a mortgage that's not government backed. The government has nothing to do with guaranteeing that loan. And we're going to talk about what guaranteeing means in just a minute. Just take it from face value right now. But the government has nothing to do with guaranteeing that loan. And here's the reason the government doesn't have to worry about trying to guarantee that loan. Because investors are satisfied that that loan is not going to fail. Investors want to own that loan. See, what you have to get past is this idea that banks really care who the borrower is. Do you think Bank of America cares what your credit score is? No. Do you think Bank of America cares how much money you make? No. But why do they bother checking all that then? Say that again. Because whoever's going to buy that loan from Bank of America cares about all those things, right? And Bank of America is not going to make a loan unless they can do what with it? Sell it. That's why Bank of America cares. See, that's the way the mortgage market functions right now. Bank of America doesn't set their own policies for lending. Wells Fargo does not set their own policies for lending. These banks go pull up Fannie Mae's policies. And they say, tell us what you'll buy. Tell us what the worst possible credit score is, what the worst debt-to-income ratio is, and we know that everybody who's better than that, you'll buy the loan, and guess what? We'll make a loan to anybody who matches that criteria. Does that make sense? And they do that because they know they can sell it. Right? So, when Ginnie Mae was originally created, it could borrow money from the federal government, but it was only purchasing what kind of loans? Conventional loans, which are really high credit worthiness loans, right? The key here is there's no guarantee on them, and the reason there's no guarantee on them is because they don't fail very often. Why do they not fail? Who are you lending to?
Good credit people.
Really good credit people, good income people, and people who are doing what? Putting a lot of their own money down. Because remember, if you get foreclosed on, the borrower loses theirs too, right? So people who put a lot of money down, are they much less likely to just walk away from it? Right? So, Fannie Mae was created and we said, these are the kind of loans we're going to buy. Great. If the market goes down, Fannie Mae can borrow money from the federal government. Great. Worked well. Over time, there were growing concerns, though, that left a lot of people out of the mortgage market. People who didn't have great credit. People who didn't have the greatest income. And primarily people who didn't have what? Go ahead and say it.
Money to put down.
How much money to put down? 20%, because that traditionally was considered the cutoff for a conventional loan, where you had to put down at least 20%. Is 20% kind of a high number to put down? Yeah. Especially by today's standards. So that locked a lot of people out of the mortgage market, right? You're saying, because remember now banks have shifted their dynamic. They will make loans to whoever Fannie Mae will buy the loans for. Does that make sense? And Fannie Mae says, well, we'll buy loans as long as somebody's got good credit, good income, and they put down how much? 20%, because that's what our investors are comfortable with. Now, who are the investors?
Pension funds, us.
Yeah, people who buy stock in Fannie Mae. Remember, it's a corporation, right? How do you ever invest in a corporation? You buy stock in it. And so that's how investors buy stock in or how investors invest money in Fannie Mae, so Fannie Mae can buy mortgages. They buy stock in Fannie Mae. Does that make sense? Everybody okay?
How's that stock doing, like today's time?
Pretty well right now. Solidly well right now. Interest rates are so low, it's not gonna do really great because, I mean, it's not doing nearly as well as it was in 2005. But those numbers were dramatically inflated because the mortgage market was dramatically inflated back then, before the balloon pop. But the government tried to address this problem, they saw it as a problem, of lots of people who were locked out of the mortgage market. Primarily a group of people that they saw as heroes, who they wanted to make sure had the ability to participate in the American dream of owning a home, who had done a great service for their country, who did not have 20% to put down because they had not been here for a long while. They had been off somewhere fighting a big war. The government created the VA loan program. The VA loan program is for who? Veterans. And the great thing about the VA loan program is it allows up to 100% loan to value. You didn't have to have any money to put down. That sounds great on paper, doesn't it? Here's the problem though. Who do we need to buy these mortgages before the bank's going to make them? Say your name. Fannie. We need Fannie to buy these mortgages. Otherwise, the banks are going to say, yeah, it's great you got this loan program, but I can make that loan, but I can't do what with it? Sell it, so therefore am I going to make it? No. So Congress created the VA loan program and nobody made VA loans. And nobody made VA loans because the investors, the people who bought stock in Fannie Mae, said we're nervous about that 100% loan to value. Does that make sense? We're nervous that they don't have any skin in the game. We're nervous. Make us not nervous. And that's how you come into the idea of mortgage insurance. Mortgage insurance is there to make investors not nervous. Because you take the risk of default off of them. At least for a big portion of the loan. Is everybody following me so far? I realize I'm doing a lot of talking. Y'all are doing a lot of staring and you're not doing a lot of nodding or anything else. You need to know this. If you don't, you will fail this exam. I'm telling you. This lecture right here is make or frickin' break for this class. So if you need to stand up to wake up, do it. I cannot overstress it.
You're recording it?
Yes. Because you got to understand this. So, how do you make investors more comfortable with buying loans that are at high loan-to-value ratios? You insure them against default.
For 20%.
You say to that investor, well, why are you comfortable with this conventional loan? You'll buy this because this one's 80% loan to value, right? Because they're putting 20% down. But this one over here, if this number is what you're not comfortable with, how can we make you comfortable? Well, the investor says we'll make it look like that number. You know what? That's exactly what the federal government did. Did they change VA loans to 80% loan to value?
No.
No. But what they said was,
Sure.
we will insure, we will guarantee, we will back that loan against default. Now, do they back 100% of the loan?
Just 20%.
No, because they don't back this one at all, right? So what do? They back the difference, right? So what percentage of that loan to value is the government insuring on a VA loan? 20%. Does that make sense? If the loan defaults. Only if the loan defaults, right? If somebody pays a mortgage payment, does the VA guarantee ever make a difference?
No.
No. But in the event of foreclosure, the lender repossesses the property, forecloses on the property, sells it, and let's say they sell it, let's say the VA loan was for, we'll use easy numbers, $100,000. 100% loan to value, right? They foreclose, they sell it, and they sell it for $86,000. Now, how much money was lost on that? How much money was lost when they got a $100,000 note out there and they foreclosed and they sold it? They lost 14 grand, right? But how much of that $100,000 loan was insured by the federal government? $20,000. How much money did the investor lose on that loan? Absolutely nothing. Not one dime. Who lost the money? The federal government. Do you see why that would make an investor much more comfortable buying that loan? Because that makes that loan no more risky than this loan, if I'm the investor. Right? Does everybody follow that? Do you think that led to a rise in the number of VA loans that were made, bought, and sold? Yeah. Absolutely. Absolutely. And as a matter of fact, that's where the other young lady comes into the picture. Not Fannie Mae, but Ginnie Mae. Ginnie Mae was created specifically to buy government-backed loans. That's the purpose of Ginnie Mae.
Did all veterans get VA loans?
If they want them.
But you can also get a conventional loan?
Sure,
Okay.
absolutely. Get whatever loan you want. It's just available to you.
Okay.
So is Ginnie Mae still around today?
Ginnie Mae is still around. Because Ginnie Mae's purpose is to buy government-backed loans. Now, is a VA loan the only type of government-backed loan?
No.
What's the other big one? Bigger than VA? FHA. Now, talk to me about FHA. Is it 100% loan to value like VA is? No. Not quite. Close. Not quite. 96.5. 96.5% loan to value for for FHA loans.
How much, 96?
96.5. So that means you gotta bring how much to the table? How much do you need for a down payment? 3.5%. Is 3.5 better than 20? Absolutely. Absolutely. Same deal here. The government will insure everything above what percentage? Where do they not insure? At 80. 80% don't need insurance. So if FHA is 96.5%, what percentage is the government insuring? 16.5. They're insuring the difference between the two, folks. The first 80%, is it ever insured by anybody? No. And here's the reason. If somebody's putting 20% down, we don't need them to have insurance because they've got enough skin in the game that they're probably not going to default. Has that sunk in through your obviously thick skulls yet tonight? I've already said it like 12 times. You realize that, right? And you still don't know it. And that's why you will fail this class if you don't learn this chapter. Because I can say it over and over and over, but until you can repeat it back to me, until you can turn it around in your head, you haven't learned it. What percentage of a loan-to-value ratio does not need to be insured or backed under any circumstance?
80%.
Up to 80% loan-to-value. Anytime we go above 80% loan-to-value, we need some kind of guarantee, some kind of insurance, right? In the case of a government-backed loan, who's providing the insurance? The government is. In the case of a VA loan, how much insurance are they providing? 20%. In the case of an FHA loan, how much insurance are they providing? 69. There we go. Now, we're getting there. Everybody's the same way, trust me, it's not y'all. Everybody has thick skulls when it comes to this stuff. Okay? So, the FHA and VA loan programs took off because now the government was willing to guarantee what made investors scared of those loans. Right? That's where Ginnie Mae comes in, because Ginnie Mae is the government. Remember, Fannie Mae is a private corporation, right? It's got stockholders, they make money, they invest money. The only thing that relates to the government with Fannie Mae is they can do what? They can borrow money from the government if and when they run out of money. When would they run out of money? When nobody's buying what? They're the ones that buy the loans.
Their stock.
Investment.
When nobody's buying their stock, that's where their money comes from. When their stock's losing value and people aren't buying their stock, and loans are defaulting, because remember they're getting the interest from these loans too, right? When those things are not happening, they run out of money. That's when they can borrow money from the federal government. Any other time, the money that they use to buy loans is generated based on people buying their stock, the earnings from their stock, the earnings from the interest on all those loans that they hold. Remember, somebody's collecting all this interest, right? And that somebody's usually Fannie Mae, eventually. Is everybody with me on that? Ginnie Mae is the government. Ginnie Mae was designed specifically to apply this guarantee. So how do you apply a guarantee to a loan? If you're the federal government, well, you buy the loan first. And then you sell it to somebody else with a guarantee stamped on it. Can you go buy a used car that has no warranty on it? You, personally. Go buy a used car that has no warranty whatsoever on it and sell it to somebody with a full bumper-to-bumper warranty on it that you guarantee.
Yes.
Yes, you can. See, y'all ain't thinking. You don't think. You just say, because you think warranties only come from one place. No, they don't. Warranties come from who you buy the thing from, right? You buy a new car, where's the warranty come from? The dealer. The person you bought it from. Let me ask that question one more time. Can I go buy a ragged piece of you-know-what car off the side of the road and put a full bumper-to-bumper warranty on it for the next person I sell it to? Yes, I can. Because it's me making the guarantee. So if it breaks, who's got to pay? Me. I didn't ask if it was smart for me to do that. I said, can I do it? And the answer is what?
Yes.
Yes, I can guarantee whatever I want to. It's the same question as, I got my property via a quitclaim deed, can I give somebody a general warranty deed?
Yes.
Isn't that the same question?
Yes.
Of course I can, because who's making the guarantee? I am, and I can make any guarantee I want to, right? Anything I want to attach a guarantee to, sure. I'm just making myself responsible. That's how Ginnie Mae works. The government, through Ginnie Mae, buys these mortgages first, puts a guarantee on them, and then guess where they get sold to? Who's buying on the secondary market? You ain't connect investors, yes, but through what? Thank you. Sooner or later, the connection's gonna happen, I promise. If I scream enough about it.
So
How
Jenny
come they don't
is
sell it to
independent,
the
like,
first market? Is there,
First market doesn't buy mortgages,
Oh, they
they make mortgages.
they make them with the guarantee, then they push it to the family.
They sell it to Jenny first. Jenny guarantees it,
And then it's
sells it to Fannie.
I need a flow chart.
I'm sorry?
I need a flow chart.
You need a flow chart?
That would help.
You need a flow chart.
Yeah, Art was drawing all this stuff.
Well, here's what you have to understand. Ultimately, almost every loan in this country on a residential property ends up in the hands of Fannie Mae. Just as simple as that. That is the indefinite destination for any flow chart you write. Fannie Mae's at the end of the line for everything. They own it all. They are the currently their balance sheet is $28 trillion. Those of you who want to do the math on that, $1 trillion is 1,000 billion, and a billion is 1,000 million. That's a lot of mortgages that Fannie Mae has on their books. Everything eventually makes it to them. The question is, do they buy it directly? Which ones do they buy directly?
eventually.
The really pretty ones. They buy the pretty ones directly. They buy the shiny cars that just came off the assembly line, right? Because we don't have to worry about that one breaking down, right? But they end up with all the ugly ones too. What do they want before they buy the ugly ones? A guarantee. And in the case of FHA and VA loans, where does that guarantee come from? The federal government. Does that connect a little bit now? Do you understand? Are you willing to buy the ugly ones if the other ones come stamped with a guarantee that they won't break down?
Yes.
Or if they do break down, the government will pay. Better? Is there anybody who just completely bumfuzzled by all that? It's okay if you are. I promise it is. But I want you to get there, okay? Everybody pretty good on that scenario. Just flow chart aside.
Is Jenny Mae
Give 'em a flow
allowed to
chart.
make a profit?
I'm sorry?
Jenny Mae allowed to be making a profit?
Ginnie Mae does not generate a profit.
So they have to get rid of them?
They turn them over. Guarantee them, turn them over. Matter of fact, Ginnie Mae always operates at a loss because eventually some of them are gonna fail, right? And they're the ones making the guarantee. So it's Ginnie Mae paying Fannie Mae when they fail, right? And where's Ginnie Mae's money coming from? From the federal government. Okay?
So Jenny Mae just gives them always time,
Once they guarantee them,
right, and nothing else.
that's what they do. That's what
Where
their
do
purpose
those
is.
names come from?
Because Ginnie Mae stands for the let me make sure, the General National Mortgage Association, I believe it is. The Government National Mortgage Association, sorry, Government National Mortgage Association, GNMA, Ginnie Mae.
Okay,
Fannie Mae is the Federal National
Okay.
Mortgage Association. Okay? That's where they come from.
I
Just
didn't know
because
if they
they're-
was after
Just
someone.
because the acronyms look like that.
Okay.
Is that, as simple as that.
Mhm.
Okay? All right? So, now we've got a system set up where you can pretty much have any borrower, no matter how much of a down payment they have or don't have access to a mortgage loan. That ultimately will be bought in the secondary mortgage market, and if it's bought in the secondary mortgage market, the lenders on the primary mortgage market are willing to do what? Give the loan. If they can sell it, they'll make it, right? So that opens up the credit markets. It makes the credit market move, keeps things rolling. That's what this whole secondary mortgage market is about, is to keep it rolling. Keep the skids greased, keep the money flowing. Okay? Are we all good on that? Or at least better than we were?
Will banks always sell their loans?
That's a good question. Not always. Not always. Occasionally banks make what we call portfolio loans. A portfolio loan is a loan that the bank is going to hold the note. They're not going to sell it. But in most cases, they do that now for special customers. You know, maybe they've got a loan that doesn't meet Fannie Mae's requirements. Somebody can't document their income. I mean, banks have a pretty good idea how much income you make, right?
Yeah.
They see your deposits. Are there people in this world who make a lot more money than it looks like they make on paper? I'd be one of them.
Stop.
My tax return last year said I made $48,000. I did not make $48,000. Thank God, I did not make $48,000 last year. But because I'm very liberal with my deductions when it comes to tax time. Business expenses add up quickly, you know, and you can quickly whack off $90,000 or so. But the point to that is, if I go to a bank to take out a mortgage loan, and it's a fully underwritten loan that they're gonna sell, what income are they gonna use to qualify me? 48, whatever is on my tax returns, right? Now, if I have a relationship with that bank where I'm making $150,000 a year of deposits in that bank, and maybe I have some CDs with them and money market accounts with them, might they have some incentive to loan me more money than a $48,000 income would ordinarily qualify me for? Are they going to be able to sell that loan? No, because it's not going to meet Fannie Mae's guidelines. That's the kind of a case where they might make a portfolio loan. And they're free to do that. And in that case, it's completely up to them. Whatever criteria they want to do.
So then, they would not sell it to anyone other than Fannie Mae?
They wouldn't sell it to Fannie.
No, I'm saying any other type of loan. Like, if they're selling a loan, it's going to Fannie.
Not exclusively, mostly. The vast majority.
Yeah, can you buy directly from Fannie Mae? The loans they give to Fannie?
Investors? No. Ginnie Mae, everything goes directly to Fannie from Ginnie Mae.
Can you go to a bank and say, I want to buy some of your loans?
I'm sorry?
Can you go to a bank and say, I want to buy some of your loans?
They have avenues where you can do that, but you'd have to have some real deep pockets. They're not gonna sell them to you at $100,000 at a time. Maybe 10 or 15 million at a time.
Okay, you've probably already talked about this, but veterans, qualify for VA loans. Who qualifies for it?
We haven't talked about it yet.
Oh,
I'm gonna
okay.
get ready to get there. I wanna make sure everybody understands the relationship, and then we'll get there.
Okay.
Yeah, we have not gotten there. Okay? So, and then Freddie Mac is the last one of those names I mentioned. Here's the only thing you need to understand about Freddie Mac. The last sort of hole in the donut of loans that there was nobody to buy were loans made by credit unions. And Fannie Mae wouldn't buy them because they didn't trust the credit unions. And so Freddie Mac was created in order to purchase loans made by credit unions. Ultimately, Freddie has failed, and everything Freddie had now Fannie owns. Because who ends up with all of it? Fannie Mae.
So do credit unions usually sell?
Some do, some don't. A notable one in North Carolina, State Employees Credit Union, does not. State Employees Credit Union portfolios all their loans. They package them for sale. In other words, they follow Fannie Mae's underwriting guidelines, such that if they ever needed to raise money, if they got in a credit crunch or they didn't have enough money on deposit, because right now, if you don't sell your loans, you remember you're lending your deposits in essence, right? You know, so if everybody tomorrow decided they want to take their money out of State Employees Credit Union, they wouldn't have enough money on hand because they've loaned out most of it to people getting mortgage loans, car loans, right? So that's how banking works. But if that happened, they've packaged all these loans for sale, and they could immediately sell them to Fannie Mae and raise billions of dollars if they needed to. But they do not sell them as a matter of course. They don't have to. They're very well capitalized. State Employees Credit Union is the second largest credit union in the world. North Carolina State Employees Credit Union. The only bigger one is Navy Federal Credit Union.
Can anyone get,
No.
an account for them?
No. You have to be a state employee or be a state employee, be the immediate family member of a state employee, or share living expenses with a member state employee. One of those three categories. Okay? So, we talked about what conventional loans are. Remember, conventional loans are just ones that are not guaranteed by the government, but most of the time, what loan-to-value ratio do they have? 80% or higher or lower?
Higher, lower.
Lower. Because anything above 80% is going to trigger some kind of mortgage insurance, right? Now, can we have conventional loans that have mortgage insurance? Yes, absolutely, because I didn't say the definition was 80% loan to value or lower. I said the definition is not backed by who? Federal government. Can we have backing that comes from somewhere other than the federal government? We call it private mortgage insurance. Private mortgage insurance works the same way as government-backed mortgage insurance, in theory. Here's the difference. When the mortgage industry fell out in 2008, 2009, all the private mortgage insurance companies declared bankruptcy immediately and didn't pay on any of their claims. The federal government did not declare bankruptcy and did pay on their claims. So there is a difference between private mortgage insurance and government-backed insurance.
But those businesses went out of business.
Completely.
Came back, right?
In most cases, completely gone. Okay? So, private mortgage insurance is mortgage insurance on conventional loans that have greater than what loan to value? 80%. So if I get an 85% loan to value conventional loan, am I going to have to buy private mortgage insurance? On what percentage of that loan to value? 5%. Does that make sense? Okay. Is the mortgage insurance going to be more expensive on a 90% loan to value conventional loan than an 85% loan to value conventional loan?
Yes.
About 95%?
Yes.
Absolutely. The further you go up that chain, the more likely you are to default.
Right.
Because the further you go up that chain, the less of your money you've put in the purchase, right? And the less of your own money you got tied up in the purchase, the more likely the bank sees you as somebody who's just going to walk away when you go and get stuck. Right? So, the higher you go up that loan-to-value chart, the more expensive your mortgage insurance is. And again, the whole purpose of mortgage insurance is so investors, i.e. Fannie Mae, are comfortable buying that loan, right? That's the whole idea behind mortgage insurance. Make the investor comfortable buying that loan.
So did I give you right PMI only for conventional loans?
Only for conventional loans. Because conventional loans, the definition of a conventional loan is not backed by the government. Mortgage insurance on non-conventional loans, non-conventional automatically means backed by the government, right? So that means the government is providing the mortgage insurance. So PMI is only on conventional loans. Okay? We've already talked about how to do loan-to-value ratios. Y'all have done plenty of them. As far as conforming loans, don't worry too much about that. You won't see any questions about conforming other than to know what the terminology means. As far as a math question, I do not think you will see one about a conforming loan. What you need to know is that Fannie Mae has a certain number for every county in the country that they will back the loan up to that number. Okay? For example, in Wake County, that number is $417,000. So you can take out a VA loan in Wake County up to $417,000. You can take an FHA loan up to $417,000. But any higher than that, and the federal government will not back that loan any longer. Okay?
So in that case, can you use a PMI loan?
In that case, you'd have to get a conventional loan because you can't get a government-backed loan. Okay?
They're conventional loan.
You'd have to get a conventional loan which has PMI on it, right? And conventional loans that go above the conforming limit are called jumbo loans.
Like
Right.
95%?
No, they have anything to do with the loan-to-value ratio. Above the dollar limit for a conforming loan. Remember, the conforming loan amount is a maximum dollar amount that you can borrow, and it's based on zip code. The reason it's based on zip code is 417 would be laughed out of town if you're in San Diego, right? It would make an FHA loan or a VA loan completely obsolete because you can't buy anything for those amounts there, right? So it's based on the cost of living in your zip code as far as the maximum conforming amount. The maximum conforming amount here is $417,000. You don't need to know that, but just to give you an idea of the kind of numbers you're working with, which is a pretty sizable loan. So that means you, as long as you're not borrowing more than $417,000, you can get an FHA loan, you can get a VA loan, and you meet the other qualifying criteria. You can borrow up to that amount, which means a conventional loan up to that amount is called a conforming loan. But a conventional loan greater than that amount is called a what? A jumbo loan. So in Wake County, a loan of more than $417,000 is a jumbo loan. Okay? In the real world, what you would end up doing, because jumbo loan rates are always higher, is you would probably end up with two mortgages. You'd take out one conforming loan of $417,000, and then you would take out a second mortgage for the amount above that you needed to borrow, rather than doing a jumbo. Try to avoid jumbos in most cases because the rates are significantly higher.
So if you take out a conventional loan that's 80% loan to value,
Yep.
does that mean that the person borrowing the money pays 20, the difference?
Yes, that's exactly right. It means they're borrowing 80% of the value of the property, so they're putting 20% down.
So in that case, they don't need PMI, right?
In that case, they don't need PMI because that's considered a not risky loan.
But anything higher than 80, like a 90%.
It's
commercial loan,
gonna require PMI if it's a conventional loan, right? If it's a government-backed loan, it's automatically gonna have insurance on it, but not private mortgage insurance. It's gonna have government-backed mortgage insurance. And government-backed mortgage insurance is gonna be at these much higher loan-to-value ratios.
Right.
You won't see a 90% FHA loan.
Right.
It's gonna be automatically 96.5%. VA is gonna be automatically be 100%. Everybody follow that? And the reason for that is FHA mortgage insurance and VA mortgage insurance, the prices don't change based on your loan to value, whereas with PMI, a 90% loan to value loan, the mortgage insurance is cheaper than a 95% loan to value loan. You know, the mortgage insurance gets more expensive on PMI as you go up that scale, whereas with FHA and VA, it's just a set amount. So therefore, the loan to values are set amount.
You may have said it, but with the VA and the FHA loans, can you put down more than, like, for example, on the VA or FHA? Can you put
That's what
down
I'm
five?
just saying.
You
You
can't.
can,
Oh, you can't, okay.
but
you
it would
can't.
be silly for you to do so because you're gonna be paying mortgage insurance as if you had borrowed that much higher amount.
So no one would ever want to do that.
So nobody would wanna do that if they had any money sense about it. I'm not saying people don't do it,
What if
but,
the credit is bad and things like that?
well, again, they're gonna be very cut and dry
Yeah.
credit score limits, and no amount of money
It's not
in the
gonna
world is gonna matter for that, because Fannie Mae sets those guidelines. We will buy loans. Remember, Fannie Mae, just because it's a government-backed loan, doesn't mean it changes the credit
Okay.
requirements, right? Fannie Mae has the same credit requirement for any loan they buy, period. 640 credit score, whatever it happens to be. If it's lower than that, we won't buy it, okay? So the government backing process doesn't have anything to do with that, because it doesn't change the borrower. What it does is allows them to borrow. Really think of it this way. There's no such thing as an FHA loan. There's no such thing as a VA loan. What there is FHA mortgage insurance, VA mortgage insurance,
And PMI.
or PMI. If you're putting 20% down, you don't need any of the above. When you go above that 80% loan to value, you need to decide, am I gonna do private mortgage insurance or am I gonna do government-backed mortgage insurance? If I'm putting down more than 3.5%, private mortgage insurance is gonna make more sense. Because the FHA mortgage insurance is gonna be priced for 96.5%. I don't wanna be paying mortgage insurance for 96.5% and only borrowing 90%. That's a bad math.
No, yeah, that makes sense.
And the truth of the matter is, the government-backed mortgage insurance is much more expensive than PMI.
Really.
Yes. Government-backed mortgage insurance is a big moneymaker.
Didn't that just go down, like in February, didn't the rate go down for that?
Ugh.
Or maybe it was PMI went down.
PMI may have adjusted down, but government-backed mortgage insurance has continually gotten more expensive. It is extremely expensive in fees to get an FHA loan or VA loan.
Yeah.
They are not desirable loans from a fee standpoint. They are expensive loans from a fee standpoint. But if you don't have the money to put down, you don't have a choice, right? Either buy with a VA or buy with an FHA or don't buy. Okay? So, FHA insured loans, we talked about the fact that they are 96.5% loan to value loans. They are available to anybody who meets the basic credit qualifications, credit and income. As long as you have the minimum credit score and your debt to income ratios, your income qualifies you for that purchase, then you qualify for an FHA loan. There are no qualification rules for FHA loans. Okay? Yes?
One thing that really confused my head.
Okay?
It seems like Fannie Mae will make all the rules, but then they kind of like, I'll put it like this. You have, a homeowners association, then you have the zoning laws. Whichever one is,
More strict.
yeah, it's kind of, is that the same thing? Fannie Mae makes rules, but VA makes stricter rules?
No.
FHA makes.
VA doesn't make any rules. VA doesn't make any rules. The VA, all they do is provide,
You said guidelines though.
they have guidelines for qualification, that's it. For can I get a VA loan? Fannie sets the guidelines for who qualifies on a credit basis. The VA sets the guidelines for who qualifies on a need basis. Can I personally get a VA loan? Because not everybody can.
Only veterans, correct?
Only veterans.
So that's their guideline?
Veterans and their qualifying spouses. Okay? So the VA doesn't set a minimum credit score. No such thing. They don't care which credit score it is. Because it's Fannie who's going to be setting that guideline, because it's Fannie who's going to be owning the loan. Does that make sense? The only thing the VA has to do with in that process is putting the guarantee on it, the mortgage insurance on it. And if you qualify under Fannie's guidelines for credit and income, then you qualify. That's it.
Fannie Mae is about, the money, I guess.
Yeah.
And VA and FHA is about the person.
Yes, but you're, VA and FHA aren't about anything except guarantees, that's all they are, they're insurance. It's an insurance policy, it's like you calling and getting health insurance from Blue Cross and Blue Shield, they don't give a shit about you. All they care is that you pay your premium. That's it,
Insurance company.
that's it, I mean, that is the truth of it, and that's the way FHA is, as long as you pay your mortgage premium, your mortgage insurance premium, which is part of your payment, they're happy to stamp that guarantee on that. Because it's not them lending the money, that's the other thing you need to understand. FHA's not lending any money. Who's lending the money? No, not Fannie, the bank. The primary mortgage. Fannie operates in the secondary mortgage market. The money gets loaned in the primary mortgage market. So Bank of America is making the loan. Wells Fargo is making the loan. Citibank, Chase, State Employees Credit Union. Yes.
So the bank is making the most money off all the fees they charge you to give you that in the beginning.
To provide that service in the beginning, that's exactly right. In most cases, the bank will have sold your loan the day you close,
Oh, wow.
in most cases. Their job is done once you sign the loan documents. They may continue to collect the payments, because that's called servicing the loan. And Fannie Mae doesn't really have a way to collect payments. So Fannie Mae may pay them a fee to basically collect the payment and send it to them every month. They become like money handlers.
Why can't they collect it?
Why can't they collect? They just don't have, because Fannie Mae doesn't know who you are. They don't have your name, they don't have your address, they don't have anything. Whereas Bank of America's got everything, because they just get the loan, right? And you're expecting to send money to Bank of America. So what's gonna be better for Fannie Mae in the long run? Pay Bank of America a small fee to continue to collect that money where you know where it's going, or have to try to get in touch with you and you think it's BS because it just came in the mail and somebody says, no, don't send your payment to Bank of America anymore, send it to us, and you don't know who us is, right? So that, and what usually happens is the lender continues to service the loan, even though they've sold the note over to Fannie Mae. Alright? And sometimes it does change where your payments go, you will get a letter sometime. They'll change servicers on you. Alright, so FHA insured loans, anybody can get one as long as you meet the minimum credit criteria that comes from Fannie Mae. They'll buy the loan, you can get an FHA loan. 96.5% loan to value ratio. You pay an upfront fee at closing, and you pay a monthly mortgage insurance fee. Right now, that upfront fee is 1.5% of the loan amount. You don't need to know this for the test, but just to give you an idea. 1.5% of the loan amount, plus you pay 0.75% every month. So effectively, it raises your interest rate by almost a full percent every month.
What kind of insurance was that?
That's FHA, mortgage
FHA.
insurance. Yeah. Okay? VA loans. Now, let me talk about this first. Prepayment penalties, assumption, when it comes to government-backed loans. So government-backed loans will be FHA and VA, that's what we've talked about so far, right? Prepayment penalties, can you have them?
No.
No. Government-backed loans, you cannot have them. Assumption, is it allowed?
Yes.
Yes, not only is it allowed, it must be allowed. So now going back to Monday night, when I screamed at you about those clauses that go into mortgage notes, I said there was a clause in there called an alienation clause or a due on sale clause. Do FHA and VA loans have a due on sale clause in them?
No.
No,
Do they?
no, because assumption is allowed, and those clauses prevent it from happening.
That is the perfect answer. She said, because assumption is allowed in FHA VA loans, and because an alienation clause would prevent assumption. Remember, what does an alienation clause say? If you sell it, you gotta do what?
Pay the sum.
Pay the loan off. How you gonna pay it off and have somebody assume it? If you pay it off, it's gone, right? So, an alienation clause prevents assumption. So, do FHA and VA loans have alienation clauses in them?
No.
Everybody say no. They don't. No, they absolutely do not, because they are fully assumable loans. So, how many of you really understand what assumption is? Be honest. How many of you get it? Not very many hands.
It's
taking over your loan, right?
Somebody's taking over your loan. Why though? Tell me why. Why does that make sense?
Because you gave it to them.
They can't get credit to buy a
No, that is not why they can't, not, it has
Because they
nothing to
wouldn't
do,
sell that.
because if they're gonna assume a loan, they gotta qualify.
It may be cheaper interest rate, maybe.
Say that again.
Oh,
The only reason assumption would ever be something you would consider is if the interest rate on this loan is better than the interest rate you could get on a new loan. It has nothing to do with not being able to qualify for a loan. It's a damn loan, of course you gotta qualify.
Oh, yeah.
You're assuming a loan, right? Fannie Mae's not gonna let you just assume this loan. So that means, think about what you, think about the logic of what you just said. My cousin got terrible credit, so I can go buy the house, because I have good credit, and then just sign it over to him next week, he can take over my loan with his 320 credit score.
Someone might give them that.
That's insanity, right? What would my cousin have to do if he wanted to buy my house and assume that loan?
You have to qualify.
He'd have to qualify just like he was taking out a new FHA loan, even though he's taking over mine. Okay? So the only benefit to assuming a loan is if Dusty has bought this house in 2014 and his interest rate is 3.75% on a 30-year fixed FHA loan. 3.75%. In 2018, interest rates have gone up to 7%. Do me a favor. Now that y'all know how to calculate interest, all right, let's just use easy numbers. Let's say he bought it, it was at 4% interest, okay? He gets ready to sell it, interest rates have gone up to 7%, okay? So what's the difference between the two rates? 3% annually, right? The loan balance is $200,000. Tell me how much money that buyer saves by assuming his loan versus taking out a new loan. What's 3%? $6,000 per what? Per year. Divide that by 12. $500 a month. Their house payment is lower for buying that same house and assuming that loan. Does that make sense why you would do an assumption?
Yes.
So let me ask you this question, just get you thinking a little bit. 3 years from now, when an interest rate has gone to 7%, is his house going to be more valuable than the one across the street that doesn't have an assumable loan? That somebody has to go out and take out that 7% loan to buy it, and that same house costs $500 a month more across the street. Is he going to be able to get more money for his house because he's not only selling his house, but he's selling his loan?
Yes.
Better believe it. Better believe it.
Have you had that?
Have I had it?
Yeah, or I mean, have you sold or bought a house for people?
No, I've never had an assumption deal, and the primary reason is pretty much since I've been in the industry, more rates have continually come down. I mean, we've had periods where they've fluctuated by, 0.5%, 0.75%, but when I first got into business, mortgage rates were about 6.5%. And they stayed, between 5 3/4 and 6.5% for the first, God, I don't know, 6 years, 7 years I was in the business, and then, you get the market collapse, and since then they've dropped to 3.5%, 4%. But all these people that are getting these FHA and VA loans right now, I mean, if the interest rates grow up, I mean, that's 3%. That's an extreme number. Even 1% though, folks, on a $200,000 loan, that's $2,000 a year. That's $167 a month cheaper by buying that house and assuming that loan. Is that going to be valuable to them as a seller if interest rates go up by even 1%?
Yes.
Absolutely.
But isn't that banks, they kind of boycott the loans that are assumable? They kind of boycott that whole idea.
So you're asking if the banks won't make you an FHA or VA loan?
No, it's not that they won't give you that loan. Oh, that's right.
That's right. They're fully assumable by law. See, that was a light going on right there. When he said, "Oh, that's right," that was when the light flicked on right there. That's what fully assumable means, right? Yeah, the bank can choose not to make FHA or VA loans, but they wouldn't make any of those fees from making them in the first place, right? And remember, at the end of the day, the bank doesn't really care what happens to the loan once it's out of their hands, because they're going to sell it, right? Now, Would they rather you come and take out a new loan versus assuming one? Absolutely.
So if you do assume a loan from somebody, you're still gonna have to pay all the same fees that they had to pay in the beginning? Oh, no, you just take it over.
Just take it over.
So,
Take it over.
Well,
There's
that's what I mean,
usually
you have to qualify,
there's
don't you?
usually an assumption fee, but
Oh,
it's
okay.
much lower
Okay.
than the fees associated with a new loan.
Isn't, what we talking about clauses just a second ago? They have the, what is it called? Yeah, basically, yeah, alienation clauses.
Well, so would an alienation clause be present in an FHA or VA
You say-
loan?
I know it's, you say no, you just.
Can't be. Federal law says it can't be there. The lender's not allowed to put it there.
So in a conventional loan, it is?
And,
Or
and
private
her
mortgage?
question is, on conventional loans, are alienation clauses there?
Yeah.
Almost certainly, because banks do not like assumption. They want you to have to take out a new loan, pay those fees again, right? So, yes, most conventional loans do have alienation clauses,
now why are VA and FHA loans assumable?
because the federal government says they are. And remember, it's the federal government who's backing them,
Right.
right? So they say, we will provide the backing, but one of the catches is you have to make these loans fully assumable. Yes?
What about refinancing? I was just saying, everyone could refinance around this time, but they probably wouldn't get an assumable mortgage
If you got an FHA,
if you have an FHA,
you
right?
got, if you
So
refinance
you
into
can
a,
refinance FHAs and
sure,
VAs?
you can refinance into an FHA, refinance into a VA, you can refinance one FHA into another FHA.
Cool.
You need to be a veteran to assume a VA.
That's a great question. So, to get a VA loan, do you have to be a veteran? To take out a new VA loan, do you have to be a veteran?
Yes.
Yes, or their qualifying spouse, but in general, you have to be a veteran, okay? To get an entitlement to a VA loan, you have to have been a veteran. Can someone who does not have a veteran's entitlement assume a VA loan?
No?
The answer is yes. Because if you think about it this way, who benefits the most from assumption?
The person who initially took it out.
Who's back?
The first borrower.
This is house.
Let me go back to Dusty's situation. What did I say his house is gonna be worth if we can assume his loan versus the one across the street where we can't?
More.
More. So is it to his benefit, if he took out a VA loan, for me to be able to assume his VA loan?
Yes.
Absolutely, and that's the reason that rule is there. Do I have to be a veteran to assume his VA loan?
No.
No. Here's the downside for him though. Your VA entitlement is not unlimited. It's a not use it one time and it's gone thing, it's a use it once at a time thing. So, if I assume his VA loan, does he have an entitlement to go out and get another VA loan? Not until I do what?
Pay it off.
Until I pay off that loan. So he would have to weigh his own, but now tell me what the only benefit of a VA loan is.
100%.
That 100% number. If I'm buying his house, I'm probably paying him some cash in addition to assuming his loan, right? So he probably has cash to put down on the next one, so he probably doesn't need to do a VA loan. Does that make sense? So that's probably a win-win for him,
He's a veteran though.
okay? All right. So that's the key for FHA loans and VA loans. Understanding, number one, that they're not really loans, what they are is insurance, right? Because does FHA lend money?
No.
No. Who does? Banks. Does VA lend money? No. Who does? The banks. All these organizations do is guarantee, and they guarantee it through Ginnie Mae, right? Ginnie Mae buys them, guarantees them, sells them to Fannie Mae. Everybody follow that? Okay? Good. Good. Over on page 317, they talk about USDA loans. That's the other type of government-backed loan. Now, the USDA loans, and yes, that is the United States Department of Agriculture, the same people who inspect your meat at the grocery store. You can also get a mortgage loan through them. This is called a rural development loan. It is designed to be used by people who live in rural areas idea here being people live in rural areas don't have access to banking in a lot of traditional ways. You know, they may be 50, 60 miles from the nearest bank, and banks may be unlikely to lend on properties that are that far away from things. And so to encourage people to purchase these properties, the USDA loan process. Now, why wouldn't people just go get a FHA loan? Because remember, everybody qualifies for FHA. So there's got to be some difference, something that makes the USDA loan better than FHA. What do you think it is? What was, yes, loan to value. What was the difference between, what makes a VA loan better than FHA? 100% loan to value, whereas FHA is what? 96.5. So what do you think is true of a USDA loan?
Gotta be more than.
I'd be like 98.
It's 100%.
Oh.
USDA is also 100% loan to value. Here's the key difference between USDA and the other two programs. The other two programs, qualification is strictly based on the borrower. Okay? If you're VA, you have a veteran's entitlement, you meet the credit, you meet the income. If you're FHA, you meet the credit, you meet the income. USDA, the property also has to qualify. It has to be in a qualified area. They have maps where they will allow those loans and where they will not allow those loans. And it's based on population density. If there's too many people, you can't get a USDA loan.
So what's the end here of the people who guarantee the?
The USDA, federal government, yeah, through the USDA. Provides mortgage insurance just like FHA does and VA does.
So is that Jenny Mae?
It would go through Ginnie Mae, yep. Still be funneled through Ginnie Mae.
Just quick, who sets the government insurance? Well, like, I guess it's just the government, but what are they called and who does it?
The Federal Housing Administration sets FHA
Oh, just the.
mortgage
it
insurance.
sets
Right,
it.
so, I mean, they're a division of the government,
Right,
right?
right, right.
And so they're providing the mortgage insurance, they decide how much they're gonna charge for the mortgage
And
insurance.
that's the same, the VA charges and the USDA?
No, VA
Oh.
sets their own rate,
Okay, that's what I'm.
and it's
okay.
cheaper. VA mortgage insurance is cheaper than FHA mortgage
Okay.
insurance. VA does a much larger funding fee up front than FHA does. They charge a bigger fee up front, but they don't charge a monthly mortgage insurance charge. And VA, not only is VA is really more than 100% loan to value. VA will allow you to borrow 100% loan to value, plus they will let you roll that funding fee into the loan. So they'll actually let you borrow more than 100% loan to value. We call it 100, but they'll let you go more. Okay? Everybody all right on the three types of government-backed loan?
And that one's assumable as well.
Fully assumable. Government-backed is always gonna be fully assumable. Yep. The only other type of loan that you really need to, two types that you really need to be familiar with for test-taking purposes, and maybe three, I'll give you 3 or 4. On page 318, purchase money mortgages, this is just seller financing, folks. A purchase money mortgage is just seller financing. That means the borrower is purchasing the property and getting a loan, but who is that loan coming from? The seller. And who are they making their mortgage payments to? The seller.
So like a rent to own.
It's not like a rent to own.
Is it like foosball?
It is, well, no, it's just,
They're just lending them money.
you're just lending them money, just like the bank would. What's like a rent to own? We talked about it in the sales contract chapter. Not a lease option. An installment land contract. You need to go back and look at installment land contracts. See, when you draw a blank like that, it ain't good.
You didn't give us 4 choices?
You're right, I didn't. But in installment land contracts, that's like rent to own, because the buyer's paying a monthly payment to the seller, but who still owns the property?
The buyer, the seller.
The seller until
last
it's fully
payment.
paid off. Now, compare that to seller financing. I'm making payments to the seller, but who owns the property?
The buyer.
The buyer does. That's the difference. So in seller financing, if I default, what would they have to do?
Go to court.
Foreclose, just like any other lender does.
Do they have to go to court to foreclose?
Yes. They'd have to do the same process as any other lender, depending on the state they were in.
Does this ever happen?
Now,
Well, seller financing? Yeah, it does. I mean, if you have a particular tough property to sell, especially in rural areas, people have bad credit, people have no credit, the property maybe won't appraise because it's just kind of, there's a lot of homes in eastern North Carolina that just are not in great shape, but people still want to buy them, So you've got heirs that own them, they don't have any money tied up in them, they do seller financing.
So when a purchase money mortgage happens, that seller can set his own terms on the money he's lending?
Absolutely.
He can say.
He's
"This
the
is
lender.
the-
He or she is the lender, so they can set whatever terms they want, that the borrower's agreeable to. And so in general, interest rates on seller financing are gonna be much higher than they're gonna be on, regular mortgage notes. Because if somebody could get a regular mortgage, they would. The only people who are gonna be getting seller financing are ones who, for one reason or another, cannot get a traditional mortgage. Either their credit's bad or the property's bad, one or the other.
Could the seller still have a mortgage on the property that they're selling?
They legally could, but as a buyer, you'd be crazy to let that happen. Because you could be making your payments to them, and they not make their payments to the bank, and you just lost the property.
It gets foreclosed on the seller
Right,
and then.
yes.
So, on these type of loans, is there a deed of trust?
Yes, in North Carolina there is,
There has to be.
because in North Carolina, that's how we process.
So they will use
Mortgage
attorneys
loans.
to.
You would use an attorney to serve as the trustee, same way banks do,
Right.
just on a smaller scale.
Mhm.
Okay, so that's a purchase money mortgage. Over on page 319, construction loans, these are loans for when the property is not yet built. There's a big difference there. Once remember, when we put a mortgage lien on a piece of property, we're placing it on the land plus everything permanently attached to the land, right? The whole idea of a construction loan is the thing is not yet permanently attached to the land. Are we really lending on the land, or are we lending on the thing that's gonna be there? We're lending on the thing that's gonna be there, but the problem is it's not yet there. And so, we do different, the loan that you do to build something is gonna be structured differently than a traditional mortgage loan. Construction loans are usually gonna be for short amounts of time, long enough to get the property what? Built. And, shockingly, they're gonna be at what kind of interest rates? Much higher interest rates. Why will they be at higher interest rates? Are they more or less risky than something that's already built?
More.
Much more risky for the lender.
They default is how a piece of land.
And that's exactly right. If you default, I got nothing but a piece of the ground.
Yeah.
And I've loaned you all this money, but it's supposed to go toward building the home. So, do you think they usually give you all the money in a lump sum, or they make you, hit certain benchmarks and they give it to you in dribs and drabs?
Installment.
Yeah. That's usually how construction loans work. All right, on page 320, you should know what a buy-down loan is. Lots of times called a 3-2-1 buy-down. Don't do it. It's not that there's anything wrong with a buy-down. The problem with a buy-down is the whole reason for it is to attract you to something that you probably can't afford. Builders are notorious for doing this. So here's what a 3-2-1 buy-down looks like. Let's say interest rates right now are 4%. Okay? If I go out and I take out a mortgage loan, I'm going to get a 4% interest rate. Or I can go buy a house from a builder who's offering to buy down my loan for 3 years. And the reason we call it a 3-2-1 buy down is because in the first year they're going to buy that rate down by 3%. So what would my interest rate be the first year on that loan? 1%. What would it be the second year on my loan? 2%. What would it be the third year on my loan? 3%. And on year 4, what would happen? It would go to 4, which is where it was supposed to have been all along. Right? That sounds great. The builder's buying my loan down, yada, yada, yada. Here's the problem. On a $200,000 mortgage, we've already established that 1% is an extra $2,000 a year in interest, right? So my house payment just went up by $167 from year 1 to year 2. And guess what it did from year 2 to year 3? It went up another $167. And guess what it did from year 3 to year 4? It went up another $167. So by the time I get to year 4, I'm paying $500 a month more than I was paying in year 1. How many people do you know that can realistically afford a $500 a month increase in their house payment over a 3-year period of time?
So the benefit
Not
is only the first year?
very many. I'm sorry?
The benefit is only the first year?
No, the benefit's all 3 years. I mean, the rate is bought down for 3 years in a row. I mean, you should have been paying that $500 a month more the entire time. But why is this attractive to builders? Why do they do it? They get rid of a home, but what kind of a home? In a price.
Oh,
If my house payment's $500 a month cheaper, what am I likely to buy?
more.
A much more expensive house. Because what ends up happening, folks, is they go in, and if they qualified for a $1,600 a month house payment, they don't buy that house that has a $1,600 a month house payment and get it bought down to $1,100 in the first year. They buy that house that should have a $2,100 a month house payment that's bought down to the $1,600 they can afford in the first year, and then what happens in year 2? It goes up to a number they probably can't afford, and then year 3 it goes up to a number they really can't afford, and year 4 they get foreclosed on.
So in that case, only the first year, the year that they're gonna kinda enjoy this house.
Exactly, because they bought something that's really out of their price range. Does that make sense? You understand what it is and why, why builders do it?
So what would a question like that look like?
It just asks if you know what a 3-2-1 buy down is. It would probably ask you, like, if market rates are 5% and Travis gets a 3-2-1 buy down, what's his interest rate in year 2? Well, it's bought down by how many percent in year 1?
By,
3%, right? So if it was 5%, what is the rate in year 1? 2%. What is the rate in year 2? 3%. What is the rate in year 3? 4%, and then year 4 will go to 5%. That's the way they work. 3 years, buy it down by 3%. 2 years, you buy it down by 2%. 1 year, you buy it down by 1%, and then in year 4, it goes back up to its normal rate.
do you know anybody who's ever done that?
Oh, yeah,
Yeah.
lots of people. Yeah. Builders offer this quite often. And it's a great thing if you're actually saving the money. Because what you should do as a buyer is you should qualify yourself based on what the payment eventually is going to be. What you know it's going to be. Can I afford not the payment now, what the payment's going to be in year 4? Can I afford that payment? And in the meantime, I'm going to save the difference or invest the difference or that sort of thing.
Not like what you said, buy a house that's totally.
It's already at their max at the lower rate, so you know it's going to become unaffordable for them moving forward. Okay?
And a lender would lend them?
Well, the lender's not doing anything. The lender's lending them a 30-year mortgage. The builder is coming behind and paying down in advance that rate for those 3 years.
Okay, I get it.
How's the builder gonna get that money back, or is it?
They don't, they get it back because they're selling more expensive houses. It's just the way, so here's what happens. Here's the net impact for the builder. The builder just spent $12,000 on the buy down, but they sold a house that was $120,000 more expensive.
So as a broker, do you advise people what this really is?
Yes, absolutely, absolutely.
They still might not say
Yeah.
stuff, it's brand
Well,
new.
you advise your clients about all kinds of things with financing. You can't, so lenders, will qualify somebody for a loan. Well, you're qualified for a $250,000 loan. I don't ask my clients what number they qualify for. I say, all right, what's the payment that goes with that? They gave you a loan estimate, what does that payment say it is? Oh, it's $1,350 a month. All right, well, how much are you paying now? You're renting now, you're in an apartment now, how much are you paying? Well, we pay $1,200 a month. I said, okay, and how much does that payment say it's gonna be? $1,350. I said, all right, so what are you doing with the extra $150 that you're saving right now? What do you mean? Do we need to be saving some money? No, what I'm saying is, if you're not saving $150 right now, then where the hell is it gonna come from next month? See, they don't think that way. Their brains don't work that way, because somebody told them they could afford it. So yes, I absolutely do interject myself in that. Here's the thing, is it talking myself down to a lower price point and a lower commission? Yes, but I don't want them as a client one time. I want them a client for life.
Right.
And that's how you make clients for life, because you actually do look out for their best interest. And sometimes in their best interest is saying, you can't afford this. I mean, I have said to clients before, look, I make 3 times what you make and I can't afford this, so I know damn well you can't. I don't care what the bank said. You can't afford it. I will sell it to you, absolutely, because I'm gonna get paid. But I will be right back up here in 2 years when you get foreclosed on. So that's your choice. Remember, you just gotta tell them like it is. Because people are very immature when it comes to money.
What do they say to you when you say that?
Oh, sometimes they look at me like I'm crazy. And sometimes they do it anyway. I mean, I've had clients that I've told, you know, you just can't afford this, and they buy it anyway.
That's what I would think, they're just gonna do it anyway.
But at least my conscience is clear, because I told them, you know, tried to help you.
I've had a lot of people jump.
Well,
on it
maybe they
for
don't
one
have
for
the
five.
income, but maybe they have money elsewhere. like in
And maybe they do, and if they do, that's fine. But they ought to be able to answer that question of where that difference is gonna
Yeah.
come from. You know, what I find is most of them just don't plan for it at all.
Yeah.
You know, because somebody told them you can borrow this much, they automatically assume that I have to, it's all or nothing. If I qualify for 250, then I have to, I need to go look at 275. That's the way brains work, and you will find that, you know. Like you go, I constantly remind people, you know that number is up to, right? There are things cheaper than that number that you can look at. You don't have to, and you certainly don't need to be going $25,000 over that number, you know.
We'll
That's,
just buy a 3-2-1, buy that long.
Yeah.
We'll be good.
yeah, right. So. Okay, let's take a break, because that's the end of the different types of loans.